I'm 61. Am I nuts to wait for 5% again now that the election is over? Hello, members, super savers, and bond course fans. I hope you're healthy and well. What a week it's been for our country. A presidential election and another Fed rate cut. And at least the latter of the two was almost a bit anticlimactic, given that the 25 basis point rate cut was exactly what the market had anticipated. So, I'm curious. Did you stay up late on election night like we did? And if you did, what time did you go to bed? Drop a comment below and let everyone know. The earliest I've heard so far was 10 p.m. and the latest was I didn't go to bed. We didn't make it too long past 1 a.m., but I still nearly fell off my Pilates machine the morning after. In any case, now that we know who the 47th president of the United States will be in January, let's get back to the business of bonds and what some of the implications might be for financial markets. Here are the three topics that we'll be covering in today's video. 1. Is it nuts to wait for 5% again if you're close to or already in retirement now that the election is over? This is a question that we've gotten a fair bit over the past several days because it seems that some folks believe that yields and inflation will necessarily go up under a Trump presidency. So let me give you my take on this. 2. Which treasuries rose and which ones fell this past week? And 3. What's on the upcoming Treasury auction schedule? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. At the current time, the market narrative is that economic policy under a Trump administration, such as increased tariffs, tax cuts, and higher deficit spending, would be inflationary and as such lead to even higher rates for even longer. This, coupled with the fact that bond yields have been going through a good season in the past several weeks, have some of you once again contemplating whether you should go long now or wait it out again until yields go even higher. And I say again because the Diamond NestEgg fan who emailed us this question had also reached out to us earlier in 2024 about how upset and stressed they were after missing out on the run-up in bond yields last October. So, here's my take. While there has been a fair bit of talk around increased tariffs and inflation under a Trump administration, we need to understand that nothing has been set in stone. In fact, in this recent Wall Street Journal article, Trump Treasury contender John Paulson suggested the tariff threats are in part a tactic to elicit concessions, such as persuading Deere & Co. to keep production in the U.S. This may or may not be true, but in any case, Paulson does remind us of an important point when he mentions tactics and concessions. Election promises will often point the voters into a certain economic direction with a reasonable degree of certainty. It is plausible to expect Trump to cut taxes, while Harris would most likely have increased spending, just as both were promising on the campaign trail. But it's still early days, and new tax cuts or new tariffs are not enacted overnight. Plus, we still don't know for sure who the big players will be in the future administration, or how other countries will react to the threat of new tariffs. I mean, at the time of this taping, we don't even know which party will control the House of Representatives, even though we know it will be a very slim majority for whoever comes out on top. So, the new administration will have its work cut out for them when they move in January. And if you want a refresher on the spending and deficit challenge that is waiting for them, and that will most likely also not be fixed overnight, I've linked this recent update on the out-of-control U.S. deficit below for your convenience. So, long story short, and yes, that was my version of short, economic policy under any president takes years to play out, and in my mind, that is a very, very long time to wait for someone who is about to retire or already in retirement. Also, as I've said before, bond yields move up and bond yields move down every day. In fact, this past week, right after Election Day, some longer-dated maturities surged 16 basis points overnight as the market reacted to the outcome of the election and what it thought the economic policy would be under a Trump presidency. Well, those longer-dated bond yields, they all came back down again by the end of the week. And in fact, yields at the time of this taping are actually a bit lower than they were a week ago. You can't time the bond market, just like you can't time the stock market. So to answer this question from our Diamond NestEgg fan about whether it makes sense to wait for 5% again, a question which quite a few of you also seem to have top of mind, my thinking has not changed. If I were about to retire or already in retirement, I would be dollar cost averaging regularly into my fixed income portfolio now. I would not wait to see if and or when Washington raises tariffs, if and or when they cut taxes, and what that would mean for the deficit and for inflation, and so on. And I would not wait for treasuries to cross 5%, because while it could go fast, you might also be waiting for a very long time. And if you're one of the folks that found yourself tossing and turning at night after missing out on the run-up in bond yields last October, yes, yields have come down a bit since then, but they're still quite a lot higher than they were in the last decade. In fact, the 10-year T-note auctioned off this week at a high yield of 4.347%. And the 30-year T-bond auctioned off this week at a high yield of 4.608%. Congratulations to those of you who did buy in this week's auctions. Also, if 5% is really the figure that you have in your mind that you want or need, another option may be to move up a bit higher on the risk spectrum and look at some agencies and corporates like the ones we'll be talking about later on. So, with that in mind, let's move on now to the next section of today's video. As we so often do at the end of the week, let's compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. Overall, it was a mixed week. On the very short end, the 1 month and 2 month were down, which should come as no surprise given the Fed's 25 basis point rate cut on Thursday. On the long end, everything 5-year and above was also down, despite the initial overnight surge after Election Day that we talked about earlier. This was likely due to the fact that a bit more post-election certainty had settled in by the end of the week. The 4-month, 6-month, and 3-year were unchanged, and the 3-month, 1-year, and 2-year were up slightly. Like I said, a very mixed week. Now, let's take a look at Treasury yields from this past Friday versus the beginning of this year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd. And this row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black and decreases in rates are shown in red. Treasury yields across all maturities 2-year and below are still noticeably lower than where they were at the start of the year, although the difference has continued to narrow this past week again for the 2-year. It was at 12 basis points last week. Everything 3-year and above continues to be above where they were on January 2nd of this year. The yield curve did not continue to steepen this past week on the extreme ends. The negative difference between the 1 month versus the 30-year has even widened slightly to 23 basis points from 18 basis points a week ago. But it has still come a long way since the 147 basis point difference from the beginning of the year. And the widely used comparison of the 2-year versus the 10-year Treasury, which has been in positive territory for a bit now, has remained there, although the positive difference has shrunk to a mere 4 basis points from 16 basis points a week ago. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of this video, especially for those of you who are interested in agencies, corporates, and brokered CDs as well. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. Other than that, it's pretty quiet on the Treasury auction front. Please also note that the bond market is closed on Monday, Veterans Day, in honor of all our military veterans. So that was Treasuries. For those of you who may be interested in other types of bonds and CDs for a bit of a higher yield potentially, here's where the highest yielding new issue agency bonds stand at the time of this taping, with the highest yielding one at 5.77% from FHLB, with a first call date in February 2025. Here is the CUSIP for those of you who may be interested. For corporate bonds, there are some to choose from, but the list is not terribly long. Here's where the highest yielding new issues stand at the moment. And once again, the highest yielding one is from Deutsche Bank at 6.10%, with a first call date of November 2025. Here is the CUSIP for those of you who may be interested. For brokered CDs, here's where the new issues are currently, with the highest yielding one from Jonesboro State Bank at 4.6%, with a first call date of February 2025. The brokered CD offerings have not been very good lately, in my opinion. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to really get up to speed on bond investing and building out your bond portfolio while rates are still quite attractive, then check out this video here on our 2024 bond courses. Or come join our next live member Q&A on Sunday, November 24th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.